All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
Man, what a wild week this was. This week was bananas. It's crazy.
It has been a crazy year, to say the least. This is for April the 7th, 2023. I want to just, first of all, too, before we get into financial news, everybody out there, if you see value in Michael's channel, One Rental at a Time, he posts probably 20, 30 videos a week. All high value content, the best experts in real estate, the best experts in finance. If you see value, let's get this man to 50,000 subscribers. 50,000 subscribers. Where are you at on subscribers right now, Michael?
Please, as right now, we are at 44,970. So we are 30 short subs away from 45. But yeah, 50,000 is a big deal because we hit 50,000. I'm going to be spending some more of my own money on an event in Las Vegas, but I will not plan 1 second of that event until we hit 50,000. So let's get there. Let's do something in Vegas.
I want to say you're not planning, but I've already been planning. So let me just tell the audience, the viewer at home, if you're watching this and listening to this, trust me, we are going to have a great time. Vegas is going to be off the hook. Let's get to 50,000 subs because I'm excited. I want to get to Vegas sooner than later. So.
You and me both. You and me both.
All right. So let's get right into this week's news. ISM Manufacturing. What is ISM Manufacturing and what happened this week?
So essentially, this is a monthly report that tells you the health of the manufacturing industry in the United States. To me, this ISM Manufacturing is what I call a leading indicator. It's one of those economic reports that helps you look into the future. Okay. And it's also one of those reports that the average person doesn't understand because it's scored 1 to 100, above 50 is expansion, below 50 is a contraction. It confuses a lot of people. Okay. So let me just say it this way. Manufacturing is slowing down. It is contracting. Manufacturers are not feeling as rosy about the future. So as a leading indicator, it's one of those ones that you look at and go, that hurts. That hurts. So manufacturing did not post a good number. It's definitely contracting. It missed expectations to the downside. So yeah, it was the first of many red flags this week.
Interesting. And when you say red flag as in the recession. Okay.
Exactly.
Okay. Yep. I just wanted to be clear for the viewer. And so let's talk about ISM Service. What happened there this week?
So ISM Service, like manufacturing, is a leading indicator. Instead of building or making stuff, it's the service industry, which again, if you look at the United States, we have a growing service industry. So like the manufacturing index, it missed to the downside. It might miss by a wide margin. However, it is not yet contraction. I believe from memory, it came in at like 51.2. Expectations were like 53 something. So again, trending down, not yet contracting, but a lot of the forward indicators were bad. So if we use the red, yellow, green flag indicator, this was a yellow flag. Still growing, still expanding, but definitely slowing down. So again, a sign that the economy may finally be feeling the impacts of all of these rate increases.
Okay, very interesting. So we're starting to see things slow down. We're seeing indicators, leading indicators, not lagging indicators like some of the other data we look at.
Correct.
Okay, so let's continue then. Let's talk about payroll report. ADP reported this week. What did you see this week?
So ADP report is one of the many jobs reports. We got the JOLTS report, which I'll add here, which we didn't have in the show notes, but I'll add it. The ADP report, again, was expected to be like 250. It missed to the downside. So we're starting to see a consistent trend of economic reports missing to the downside instead of surprising to the upside. So this is a problem. But again, it's still positive. It's not yet contracting. So I think it was like 147,000. Again, roughly 100,000 miss. So again, probably a yellow flag. Unemployment, the jobs will be a lagging indicator. It's the last thing where ISM Manufacturing and ISM Service is leading to kind of tie those together. The JOLTS report. This one was interesting. The JOLTS report essentially captures job openings. For the longest time, we have had north of 10 million job openings. We lost 660,000 of them to break the 10 million threshold. So again, these are job openings. But yeah, again, a yellow flag that, you know what, the job market is getting a little dicey. Not only we're seeing headline layoffs at Facebook and Amazon and the like, but you know what, people are taking job openings down. So again, it feels like the economy is the brakes have been hit. Now the question is it the brakes, or there's two ways to stop a moving car, right? You step on the brakes or you freaking hit something.
Yeah.
So, there will be debate for the next weeks and months. Are we tapping on the brakes? Are we slamming on the brakes? Or you know what? Did we hit a brick wall? And we don't know yet, but we are slowing down.
Slowing down. Okay. It's definitely interesting. It's good to be watching your daily news and weekly news, because I love that you do all the work and continue to keep your eye and keep us updated. Let's continue. So McDonald's, everybody knows McDonald's. What happened this week with McDonald's?
I thought McDonald's was an interesting one because a lot of the layoffs that we've heard about recently were very tech focused. And, most of the country is not very tech oriented. So it's like, so what? So who cares? Well, McDonald's this week, again on Sunday, issued a note to all of their office employees to stay home for 3 days because they're going to be doing a layoff. And I think you'd be hard pressed to call McDonald's a tech company. So again, I think there's growing signs that a recession is in our future, and companies are going to right size and reduce overhead. And unfortunately, for many companies, overhead, meaning employees, is the first thing that can get cut besides capital expenditures and stuff like that. So again, is this a sign that it's spreading? Maybe. Let's stay tuned.
Stay tuned. Stay tuned. Interesting. Yeah, you would never think McDonald's, right? Like, seems like one of the most bulletproof companies in the world, right? A global leader, right, in terms of what they do. So really bizarre times. Okay, so let's continue then. 30-year mortgage rates. This was interesting. You've been talking about this for weeks and months, and I've got to say that Barry Habib, I hope he's watching you now. So 30-year mortgage rates. What happened this week?
Oh no, Barry's the man. Always follow
Barry's
Barry.
the man. Barry's the man.
Barry's the man. We're just
You're
kidding.
there too, though.
That was a joke. So it's funny. The Saturday after Silicon Valley Bank, when rates were 7% or almost 7%,
yep,
I said by April 15th that the 30-year mortgage would be below 6%. Owner occupied, 20% down, best credit. We're there. In fact, I talked to a mortgage broker today that said he quoted 5.5.
Wow.
Owner rock, best credit, 20% down. Not only that, but we are getting dangerously close to sub 6% as an average.
Yep.
Mortgage News Daily.
Yep.
Said yesterday 6.16.
Yep.
So again, I think rates are going down. I think rates generally trend down for the year. One of my 12 calls for the year was the mortgage rate would average under 6.
Yep.
I think we're heading there. And the last thing I want to say, just because it really bothers me, is we have learned that 6% mortgage rates bring demand back. It doesn't bring supply.
Right.
We'll talk about this later, but what I'm seeing happen at the entry-level home is not healthy today.
Yeah.
And my fear, I'm not calling this, but it's in the realm of possibilities. If rates go from 6 to 5.5, it's going to get wild at the entry-level home.
100%. And folks, stay to the very end of this video because we're going to connect the dots on, housing, right? Because this show is all based on housing, one rental at a time investors, homeowners, home buyers. So we'll connect the dots here. Something we said pre-roll, moving on, that, for most of the year and even probably the last 6 months, there was kind of a theme, and that theme changed this week where you would say good news, bad news is good news is bad news.
Right.
Talk about that this week. What did you see? How did that shift this week?
So I think this is important. Like, inflection points in consumer psychology is important. And I think we had one this week, and it's exactly that. For the last 9 months or so, good economic news was bad because it meant the Fed had to do more. That's what good news is bad news meant. Well, ISM manufacturing, ISM services, ADP report, JOLTS report, on weekly on it. All the stuff is bad, and now you're seeing the stock market come in. You're seeing rates go down because threats of a recession. So I just made a call on Thursday that we are now in an environment where bad news is bad news and good news is good news. So what that means is we're in it. I believe the recession will be called as Q2, and we just got to get through the bad times. This could be a 9-month, 12-month recession. It might be 18, but we are in it now. So it feels to me that bad news is finally bad news. And it just is what it is. But it is an important moment because we've changed.
Yeah, 100%, 100%. And let's connect the dots. Let's talk about housing. I think something too that you said also, I feel like it was something new said in the last week or so, where, you know, there's that fancy word bifurcated. I like how you rephrase it. You said it's actually like a better way to describe so the average person understands is bipolar, which means kind of feels crazy at times. Talk about entry-level housing. Talk about median minus, under the median, above the median. What do you see for housing with 30-year mortgage rates coming down now? What do you see?
I think you're right. I think bipolar is a better image. Because again, if you've ever seen, you know, at least like if you don't have anybody in your family that's bipolar, you've seen the movies where people are bipolar. They're docile one moment and then they're just wild and out of control the second. And I think that is the housing market. I think below the median, certainly 75% below the median where all first-time home buyers live, or most of us, lines out the door for open houses.
Yep.
Escalation clauses, over asking. It's just, I believe with every fiber of my body that the entry-level home today is crazier than a year ago. Now, that doesn't hold for the market. I think the market was crazier a year ago in total. But if you just slice out 75% of the median, I have never seen the market be more bonkers than it is today. But again, bipolar has two sides. If that's the wild and crazy, I think the luxury and the ultra luxury is about to be ice cold.
Yep.
Right? Recession, stock market collapse, don't need a second home, don't have to buy. That stuff's just going to sit and sit and sit and sit. So it's a wild time in the housing market. Most of the people that watch us are probably dealing and active in the entry-level stuff. I don't have a lot of good things to say. It's crazy. Now, if you're lucky and you're Patrick Bet-David and you've got $100 million, go write a 50% off on a $10 million home or 25. Go do it. What the heck? There are no buyers for that stuff today.
So spot on. So spot on. And it's such a wild time in that. And again, you've been talking about this for months on months and months. I think too, for the viewer, the listener, to go back and find the video that you did where you broke down the 1970s and 80s, because again, it feels like below the median. And you talked about this today on the Daily News, or on Thursday on the Daily News, and that we're probably nationally, we're going to see an average median or average price probably see a small amount of appreciation when they average out based on low transactions and based on the fact that the median below the median is so hyper crazy, especially with low rates. Talk about that just for a minute as we conclude.
Yeah. So at the end of the day, median is a number that most people don't understand. Let's just be honest. Median is one of those math terms that you learned in 9th grade that you've long since forgotten. Median is simply the middle. Line up a string of numbers, find the one in the middle, you're good to go. Most people hear median and think average. It's not average. It's the middle, which can be wildly different numbers. For example, if you put down 1, 2, 3, 4, and 100, 3 is the median. The average is going to be like 31. Right? It's just different, right? They're not the same, and stop acting like they're the same. So I think as the below the median doesn't have inventory but bids up, luxury can have massive price drops but eventually finds a place. I think the median or the middle, nationally speaking, goes up a little.
Yep. And the Crash Bros are just wrong.
It's just, they've been wrong for years. I don't know why people listen to them, but don't worry about the Crash Bros. They will keep making a lot of money. There's a Crash Bro that makes $70,000 a month and has never been right. Just crazy. It's crazy.
Folks, subscribe. Michael has 2 events. He has 2 live virtual events coming up. He has the Ladies of Real Estate. It's going to be on Sunday, April the 16th. There's an Eventbrite. You'll find it in the link here on YouTube. Also, then following week, the 23rd Sunday, I will be a part of that. You've got Jason Pritchard, which is an absolute beast. Who else is on the second card?
Beth Traverso, top 1% agent in the country.
Yeah, and slaying it in these markets, absolutely slaying. And folks, also too, by the way, bad news is now bad news. Well, guess what? That also means a lot of opportunity for those that do the work. Talk about it. Finish on that, Michael.
Yeah. So at the end of the day, investors are a clearing function for markets. I don't care what market you're in, real estate, crypto, stocks, vintage cars. Investors who go deep, have a buy box, know their market. We are a clearing function. We will get the good deals. We will put them together. We will hold the assets long term. So investors, we've been hoping for a slower market. We've been hoping for the opportunity to get creative. We've been hoping for seller financing in terms. It's here. This is what we've been looking for. We got a year or 2 ahead of us where we are going to be that clearing function, and we are going to help the market move forward. So I'm excited. I know a lot of people are scared. I get it. I've been here before. I've dominated before. I'll do it again, but it's only because I do the work. And I'm putting on these 2 events so you can see others do the work. We're going to have 7 millionaires over a course of 2 Sundays tell you what's going on. The Ladies of Real Estate, or investors working with agents, 7 rock stars. For $47, you get 4 hours on the 16th, and you get 3 hours on the 23rd. So there'll be an Eventbrite below. Check it out. You're a fool to miss either one.
I love it. Michael, thank you for all the work you do. Have a great weekend. Thank you so much.
Thanks, buddy.